Tom says, if I own stock in Apple, how would I protect the stock? Well, the best protection, in our opinion, as you know, is going to be following the guidelines of the blueprint for the far out in time, slightly in the money, married put position. The structure that gives us the single digit risk on the trade itself. Now, if I was opening a married put from scratch right now, I'd go to search by symbol. I'd go to AAPL. And by a general rule, we're going at least 150 days out in time. Due to recent volatility in prices, both the ANET position I mentioned earlier that are in the Fusion portfolio that was opened on October 4th and the Newmont Mining, not ATM position, that was opened on September 30th are both for the March expiration, which was 165 days out and 165 days out and 170 days out respectively from the open positions. Now it's just 161. But I'm probably going out to April or June. Let's go to June. And I'm going to put in less results to start. And as a general rule, the basic structure I want to start off with is I don't want to be more than maybe 2 to 3 strikes in the money, but I want to go in the money. Why? Well, we're at 140.09. As you can see, the 145 gives us an 8% single digit risk. The 150, only 7% in the money, is giving us a risk of only 6.4%. Let's go to more results. The one thing I always like to comment on in this situation is, okay, so we're not too bad here, but say, why would you pay that much money for a put? Why would I pay $20 extra for a put that's in the money? Isn't it better to pay half of that, pay only $10 for an out of the money put? But now you're taking on double the risk because the stock has to fall to this price before the insurance really starts kicking in. You're paying all time value. Now here the time value is about the same. 1019, okay, versus 1080 at midpoint. The max risk on a married put is the time value only. So this case, going up to the 150 versus going down the 130, there's actually a higher time value here at the 130 put than there is on the in the money 150, both about the same range. 7% in the money, 7.2% out of the money, about 70 cents higher time frame. So is it really cheaper? I don't think so. The rest of that value is intrinsic. The 1019 is the time value that remains. But this is not your situation, Tom. The other tool that we have that you can use is the insurance tool. And it dropped $5 today. Let's see what the high was for Apple on Wednesday. We know we hit the peak on Wednesday. Let me go to a 5-day chart, and we'll change our time frame to hourly, I guess. I'm going to try and pick the worst, it's not even that far away, but the worst possible time in this recent run-up. Let's call it 147.50, right at the open on Thursday. After Wednesday's move up, Thursday looked like the peak here. We're going to call it 147.50. Now, the insurance tool is mainly designed to say that if I have a stock that's moved up in price, how can I protect it? In other words, if I did buy Apple months and months and months ago, years and years ago, and I've been lowering my cost basis, Tom, collecting premium, doing covered calls, maybe other strategies, and actually have a cost basis of 121 with a stock at 140. What this tool, did we go to June or was it April? It was June. What this tool does shows me I have an unrealized profit of 15.8% on the position, $19 from my cost basis. And what this is showing me now is the puts that I could buy where I'd have a guaranteed locked-in profit, not as much as just liquidating right now. But if I wanted to protect the shares and guarantee a profit, we could buy the 150 put and guarantee 6.4%, be an automatic bulletproof position. What do I mean by bulletproof? The okay, sorry about that. Let me submit that again. Don't do it. Yeah, no, it did it. Okay. Sorry, this is a glitch that's been bugging me that I've seen come up twice. 2 of my customers out in Italy noticed it, and that's happening on this one. Let me try a different one. I apologize, folks. I'll stick with the 145. Just a little bit in the money. Perfect. There we go. So what I mean by bulletproof status, that means we start off with a married put. we generate income against the position to lower the cost basis and eventually cancel the risk. Even if the stock collapsed now to 120 or 125, we're guaranteed a profit of 4.8%. And yes, I can still sell calls against it, lower the cost basis further, increase the guaranteed profit, and increase the upside return. But would the insurance tool work, even in the situation where I got in earlier this week at the worst possible price of 147? And the answer is yes, but we're not going to see a positive locked-in profit. We're going to see a negative locked-in profit. Why am I going out to June again? Because that's 252 days out in time. That follows the rules in the blueprint. I don't want to buy a month by month by month put option necessarily to protect the stock. Why do we like to sell premium? Cash secured puts out of the money, in the money covered calls, out of the money covered calls even. Why do we like to sell them month by month or week by week? Because you get a better annualized return. The option that's 6 months out in time is not 6 times the cost of the 1 month out option. You're getting a lower annualized return by selling further out, even though you're collecting a higher premium out front. Same is true with buying. If I'm buying month by month by month by month, I'm paying a higher annualized cost over time than if I just bought it 5 or 6 months out to begin with, because the 5 or 6 month out put is not 5 or 6 times the cost of the monthly. It's less than that. So here you go. We're seeing here that there's some results here where I could still buy that 150 put. We have an unrealized loss of 4.7% right now. If I buy this put option and Apple continues to fall down to 130, 125, 120, 115, I can't lose more than 10.2% on the position. Now let's take a look. Now it's still a pretty high loss to take, but remember, I'm talking about a much larger move downwards. We see another 10, 15 points. I'm not saying it's possible, but if we see another 15-point move down to 125, that's about another 10% movement. You're still losing 10%. You got in at 147. But remember, that's the worst case scenario. All the way out to June expiration, 252 days away, if the stock's still trading below 150. We start to see recovery as the stock moves back up. But if the stock, say, fell to 125, by the end of this month, happy Halloween, they're still going to be down about 1,300, but that's not quite the 10% drop in the price. Close, I know. It's going to be 9.5%, 9% maybe, but we're protected now for the downturn. And we can still make adjustments as necessary in these cases. Yeah, time. Bill says time is cheaper. Buy the 6-pack in those cases. Now, this is a way to protect the positions. You can use that insurance tool, put in your cost basis there to see what position. If you got a locked-in profit, this number will be positive. If it's still a loss, this number is going to be negative. But that's how we would structure. We don't go month by month. Oh, yeah, side question came in. Could you be better off protecting the position using a Bear Put Debit Spread, either further out or closer in? We've had these discussions before. The thing I don't like about using, let's just put this at a cost base of $19.95. How would I complete a Bear Put Debit Spread here on Apple? Well, I buy the 150, and then I might sell the at the money now 140, maybe something lower, the 130 in those positions. Okay. And let's see here. Sorry, I'm in June. My apologies, ladies. I'm in June. 35. Hey, let's get half of it back. Let's sell that 130. Now remember, the married put that we just added had a max 10% risk if the stock falls below 125 or continues to drop to 120. It's a floor, and that's all the way at June expiration. Now here the Bear Put Debit Spread is going to do that for us too because we put it far out in time. Risk of 87.2%. How is that possible? We collected premium. Shouldn't it be lower? Well, the problem is now the continued protection you would have had with your 150 put against your stock shares, which just would have continued this way, is now negated by the short put obligation. So as we start to fall here, we go down to 115, we're at $2,000 maximum loss instead of $1,680 that we were seeing with the married put. because now this long put that we purchased at 150 can either only cover the stock or the sold 130 put. It can't cover both. Does this lower the risk in the case that the stock moves back up in price? Because technically we only paid $10 for that 150 put now, if assuming the 130 put expires worthless. Well, we did, because we collected $10 against a purchase of $19.95. But remember, unless the stock really goes up to say 210, 220, or 230, and lucky for you, Tom, I hope it does for you, but unless Apple goes up to those prices, you're still paying a fair price to buy back this put. It's a June put that you sold. It's not going to zero. It's losing value, but it's not going to zero. It still has 220, 180 days to expiration. There's going to be time value remaining. And that's the benefit of the married put position. And Tom had a follow-up question. How do you make money on a married put after you entered it? Well, there's a lot to that. And of course, when I say there's a lot to that, what I mean is there's a lot to that that's all described in the course, the blueprint, the different 12 to 13 different adjustments we use on the position. But one of the most important aspects to understand about the married put, and that graph we were looking at earlier, when I open this married put position, let's open one from scratch. Let's do it that way. Instead of this position where we had the higher cost basis, what if I opened a married put today, just on Apple, 140-ish price? I'm going out to June, and let's go to the more results. I think I wanted to see that 150. I'm still going to use the 150. I'd probably use the 145 to be honest, but let's use the 150. Good controlled risk of 6.4%. Sometimes what I like to tell investors, Tom, is the three little bears when we do these. What do I mean by three little bears? I want to be in the money. So I know that I'm starting off with one of those 3 or 4 strike prices that are shown. Let me click out of the. There we go. Perfect. All right, my pen. So with the stock, I don't want to buy at the money. This risk here of 1504. What I mean by that, look at they're not showing the time value because we're showing it by risk. These risk increases. But if we were just showing time value, 1495, the at the money is the highest time value at any time you're looking at an option chain. It's called the at the money bell curve, where the at the money option has the highest time value. Those, well, we're talking about puts. The puts in the money have a higher cost, but lower time premium because most of it's intrinsic. The max risk is the time premium. As you go deeper in the money, it goes deeper down. And as you go further out of the money, you have a lower time value as well, but you have a higher risk because the stock has to drop to those levels before the insurance really starts to kick in. Why is that relevant to your simple question of how do you make money after this? Well, the three bears, 2 to 3 strikes in the money. The 145, that's got a risk of 8%. That's pretty high. 155, still good controlled risk at 5%, but it's 10% in the money. Not too hot, not too cold, right in the middle of my 3 good choices here. 7% in the money, 6.4% risk with the 150 strike is likely what I would choose if I was opening a married put on Apple today. How am I going to make money on this position? Well, remember, the put doesn't go to zero when I buy it. I'm not 6.3% in the hole. I'm not down $10.06 or $1,006 for a 100 contract trade. If the stock stays the same price at 140.09 on Monday, this put's still going to be worth $19.97, $19.96. Only going to lose maybe 1 or 2 cents a time premium. If it falls, the put's going to move up in price, but I'm going to be losing more on the stock. Not much, though. This is a delta of around probably 0.61 or 0.62. I should have looked at it on the search by symbol tool, but it's probably somewhere between 0.55, Tom, and 0.65, meaning that if the stock moves up 1 point on Monday, goes to 141.09, this put's probably going to lose 40 or 60 cents. I'm seeing a profit, not the profit that I want, but I'm starting to see a profit on the position. Well, let's go back to the portfolio tools very, very quickly. And, Newmont Mining bought at 42.32, bought the 45 put. Stock's at 42.60. It's still up 0.7%. I've gained 28 cents on the stock. Right. It was up 6% at one point this week. And the put is only down 18 cents. I'm still at a profitable liquidation, nowhere near my targets, nowhere near what I do. I've only been in the position 1 week. When it was up 6%, Tom, and the whole married put structure itself was up 3%, I should have looked at it. We went up to as high as 44.90, 44.85. Now, I could have sold a call against it, but I was worried that the run-up was still going to continue. I was wrong, but I'm still profitable on this trade. Not to targets, but I'm still profitable. The put doesn't go to zero when you enter it. It's not like that covered call in those situations. What we're going to look to do is do different adjustments. Now, even Annette, it's down 3.5%. I'm only losing 1.5 because the put has gained as the stock fell, just not 1-to-1. If I go too deep in the money in those cases, I'm not going to do it. Two quick thoughts here. Tom says, excuse me, could I sell several calls out of the money? A call or several calls out of the money? Yes. And Bill says, would you sell a call now? Earlier, Bill, remember when I was talking about what we saw with the market movement? I don't know if you were here then. You're pretty close to it. When I talked about the market movement that we saw, and I talked about how I thought that we were in that very bullish buy, just like we were in June. And we saw that big downward move over a 4-day period because the inflation in May was larger than what was expected. The actual calculation was larger than what was thought. And that pushed it down. And then we had the 0.75 rate hike on June 16th. And the market sentiment tool went back to very bullish buy. I'm hoping and I'm leaning towards, I think this movement down today based on the jobs numbers and the yield rate increasing might be something similar with 3 or 4 more days down. And then we'll start to see a movement back up in price. So why would I sell a call now if I expect a movement back up? Why try to pick a price and say, yeah, I think it's going to move back up. It was just at 44.90 the other day, so I think 46 is a good price. If I think it's going to come back up, I want to wait until Newmont goes back up to 44, 44.50, and then get a better premium for selling something like the 46 or the 47 call, not the 45. Why? Because it still caps the gain just like a covered call. The married put doesn't negate that aspect. So if I just sell 2 weeks out, 3 weeks out, let's go standard October expiration 2 weeks out, and I thought about it, it's only 60 cents. My current risk right now is 357 or 7.4. I kind of want to get at least a third to a half of that risk when I sell a call, not just 60 cents. 14 days out, 60 cents, what does that do? Not the structure I want. The stock's trading at 45. Then I'd have a potential 3.6% return. Like I said, when it was up 6% to 44.90 in those cases, the liquidation was 3%. So this is a little bit better. If it's trading back at 45 on October 21st, I could make 3.6%, and I've dropped the risk down to 6.2%. But I've given myself 2 ways to lose. Now, I'm not saying in 14 days I expect Newmont Mining to crest $49.50, $50, or $51 per share. I'd love it if it did, if and only if I hadn't sold this call yet. In those cases. Let's go back in time. And yeah, let's go back to Newmont Mining. Let's go to the chain. It's Wednesday, right? Let's see what we've got. What was my price on a close of October 4th? That's when I opened Annette, but I think that's when Newmont got close to its upward movement. It was about 44.80. I don't remember where it closed. 44.75, 44.85. Those cases. Sorry it takes a while here. We're up at 44.53. So I don't think it went higher on Wednesday. We're just going to use this. So when the stock was at 44.53, remember today I could get 60 cents for the October 21st 45 strike. We're uploading all of the historical data from close of business day, so it's taking a longer time to interact with it. The October 21st 45 call was more than double the price at 144 on the 4th when Newmont closed at 44.53. That 1/3 I wanted to get of $1 roughly is at the 46 strike, gives me more room. The 47.50 is 60 cents, what I could get now. So maybe I did miss this. I agree with that. This would have been a perfect time to sell the call. Remember, when you sell a call, whether it's a covered call or a married put, you're essentially doing a bearish position. You're saying that I don't want the stock to reach or breach this point when you sell the call against it. This is just one of the income methods that we use against the position. But let's take the 46 at 102. We'll call it $1. Let's be nice. So let's say that I was able on the 4th sell the October 21st 46 call for $1. It was tempting. I actually could have bulletproofed it. I did look at that time. I could have bulletproofed the trade by selling the December 45 call. It was the December 45 call right at the money. It would have taken out the entire 357 risk, but I also don't want to do that because earnings are coming up in mid to late October. I don't want to cap the upside gain. But had I done this call for the dollar, lowered the risk to 5.4, 5.7, all the way out to October 21st here, and the upper break even is at 55.60. Still 2 ways to lose, but it's very, very wide. Bill mentions, well, dance with the market is the only reason. You're right. I didn't want to take this chance here to cap the gain yet. Maybe I missed an opportunity. But 21 October for $1 would have been good. And I'm pretty sure the earnings are after that. It's 27th. Yeah. Before market, unconfirmed, but the expected earnings is going to be around 10/27 after that standard expiration of October 21st. This was a safe move to do, I think, in this case. It would have worked out well, but I just didn't do it. And then the market was down the next day, and then it was, of course, down further today, back near to my purchase price. But I'm still at a small profit on the position. Now, let's go back to just the married put. One other benefit of this structure: is the put a wasting asset? Well, potentially, but remember, I bought it 160, 200 days out in time. The time decay is much more slow. In the first 20 to 30 to 40 days, I'm only going to be in this range of time decay, where if I bought month by month, I'm seeing this decay every month. At the money bell curve, I bought up here. I bought the stock at 42.30, and the 45 is up here. But what happened? When the stock moved up to 45, my put was now at the money, which means, yes, intrinsic value declined, but time value would have swelled. The put in the proper structure we follow in the blueprint is not just a wasting asset. It is a second asset that we can use to manipulate prices. Let's go back to that historical chain. I hope I left it open. I did. On the day it was up 44.53. We're holding the March put. While that's loading, I just want to remind everyone, let me go back here. The risk was 357. I paid 625 for the put. But at the time, $2, excuse me, and 70 cents or so was intrinsic. The remaining 357 was the time value that I paid into the position. But I paid 625 total into the position. When the stock was up to 44.53, my put 45 strike for March was at 508 midpoint. The time value swelled because of the at the money bell curve from 357 to 508. It moved up $1.50. The stock was up $2.20 from where I got in. Okay, is the put down $1.25? Yes. I'm going to be okay, $1.17. Yes, I paid $6.25. The put is down to 508. But the time value had swollen up to 508. That's part of the delta. We call it extrinsic value too if you wanted to do that, but it moved up because we went from in the money at 45 to now at the money at 45. So we're seeing this swell. Why is that important? because I could sell to close this for that 508 value, only losing $1.17, and move up to maybe the 47.50 put for a debit of only maybe $1.10 or $1.15 to get $2.50 higher payout, which would have reduced my risk, cut this down about 3% or so. The advantage of the at the money bell curve. That's income method number 4. There's a proper way to do it and an improper way to do it. But yes, income method number 1, selling calls against the position. Income method number 4, adjusting the put. There's 4 ways to adjust the put as the stock moves up and down to take benefit of those positions. There's also other riskless spread positions that are discussed in the blueprint. One of them, income method number 6, involves selling a call, but then buying a higher strike call akin to an income method number 6 trade. In those scenarios, I'm sorry, bear call credit spread, I'm sorry. And so the upside is still open in case the stock runs. You don't get as much premium, but you could do that as well. Here's what I want you to do, Tom. When you go to the married put section, or if you go to radioactivetrading.com, you'll see a sign up here at radioactivetrading.com to get the sketch. It's a free white paper that discusses the benefits of the married put position, of course, and it even talks about one of the income methods for free, and that, of course, is income method number 1. So you can just get the sketch. It's just a free white paper. But the blueprint describes everything. You can also access the sketch here on your Power Options account in the Married Put Learning Center, and Ernie also has a 4-part article here of covered call challenge, limited risk solution, and so forth. But there are various ways that we can profit. As the stock moves up, you're going to see a profit on the position, simply because the delta of the put is lower, and the put doesn't go to 0 when you buy it.